Thank you. Good morning. It is now 9:06. I'll call the Sewage and Water Board of New Orleans Pension Committee to order. Special counsel, please call the roll.
Director Kennedy,
Here.
Director Pacho,
Here.
Director Anthrop, Director Thomas, Director Stewart, Ms. Shine,
Present.
Ms. Jonesy,
Here.
Mr. McBoone, Mr. Joseph. Chair, you have a quorum.
Thank you. Now we will proceed with the first of our two presentation items, April 2026 Executive Summary Investment Report for the Employees Retirement Systems of the Sewage and Water Board, Mr. Kwaku Obed of Marquette and Associates. And then the second, the recommendation for infrastructure asset class, also Mr. Kwaku Obed of Marquette and Associates. Mr. Obed, please proceed.
Great. Good morning, everyone. So April was definitely a kinder period as we think about the markets. So we'll go back a little bit in the time machine and we'll think about why the markets have been so volatile. So February 27th, we had the war escalation in Iran. The market sold off. We saw energy prices go up over successive weeks. We're still seeing that happen. We saw interest rates go up, and we saw more volatility in the market, just given the mixed signals around the economy that rising gas prices, commodity prices have basically triggered. So the month of March was a pretty challenging month. February was also a challenging month, particularly towards the end. But April, the market rebounded. And the big takeaway here is, as we think about headlines and we think about any headlines that point to the Strait of Hormuz potentially reopening, the blockade being temporarily lifted, the market's going to rally. If we think about earnings and earnings being somewhat positive, the market's going to rally. And then anything that's to the negative of that, we're going to see the market essentially retreat a little bit. And then another thing to note is the Fed, and when we think about interest rates. So interest rates actually shot up in the month of March, given that inflationary pressures were really driving concerns around the economy. We typically see interest rates go down when the market sells off. So interest rates going up, that was also a headwind for the fixed income asset class. But as we move to April, what's happening in April? Well, we have a new Fed chairperson coming in, Kevin Warsh. The expectation is for this individual to be a little bit more dovish in terms of accommodative of lower interest rates. So as a result of that, we've seen fixed income actually, the word rally is a little bit strong, but fixed income has held up pretty decently as a result of that. So all in all, April was a pretty decent month if we look at the markets, if we look at equities, both domestic as well as international, and we look at fixed income. So a very different picture from what we were essentially teasing the last time we were at the table when we were thinking about what would the returns look like. So April was a pretty strong month. But all of this is a good reminder that we are looking at the right asset classes when we think about the diversification of the portfolio. So we think about infrastructure, and then once we have infrastructure behind us, potentially real estate. These are areas of the market that are less volatile in comparison to your equities. So these are the diversifiers we're looking to add in. But you can see for the month of April, I mean, this is a pretty staggering number, right? For a 1 month return. You're looking at double-digit returns for the S&P, the Russell 3000, up over 10%. The ACWI ex-US just shy of 10%. So really across the board, some pretty solid results as we think about the US equity market and the non-US equity market. And then the fixed income market, you can see just a modest gain of 10 basis points there for the fixed income segment. And then one thing we'll point to at the bottom, if you take a look at energy, just look at the return of energy in comparison to everything else. So commodity prices going up have been a significant tailwind for energy. And that's the quick summary of the market environment. Now the portfolio, we're in blue and the index is in gray. You'll see that we've benefited tremendously from the market environment. So returns have continued to be very strong. Year to date, we're up 6.7%, and then over all periods measured, we've done a little bit better than the index. So again, as we think about this environment, the portfolio has been very reflective of, I think, a pretty good strategy that, you know, when the market has sold off, we've done pretty well in terms of protecting on the downside. When the market has rebounded, we've done pretty well in terms of capturing the rebound. So all in all, we've continued to hold up pretty well, even though the market is not, you know, behaving in its best form. And then here we take a look at the various composites. You'll see from a composite standpoint, no real surprises here. Equities were the biggest driver of our returns. The real estate composite is comprised of REITs, real estate investment trusts, a little equity volatility there, but these were still, on an absolute basis, positive contributors. Infrastructure also listed, but a positive contributor to our returns. And then as we think about the various segments of performance that have been helpful, you can look at the Cohen & Steers infrastructure, Ernest Partners on the non-US equity front, and then BNY emerging markets also coming in with some pretty solid results. But then when we think about bottom performers, it's all relative. We have a bottom performer that's up 10.3%, and another bottom performer that's just shy of 10%. So again, we've done pretty well in this environment, both with our top performers as well as our bottom performers. And then the asset allocation, you'll continue to see here, you know, we hold a little extra cash, which again, no issues there. In this environment, cash is a good proxy for fixed income without the volatility. A little bit of an overweight to your US equities, a little bit of an overweight to your non-US equities, but again, nothing for us to act on at this particular meeting, in our opinion. We are underweight on the private equity front, and then fixed income, we're a little bit underweight there, but part of that has just been the relative underperformance of fixed income relative to the equity market. And cash, again, is a pretty good proxy in this environment for fixed income. And then this dashboard here is just a quick reminder of the actions we've taken over the last couple of quarters. And this takes us to the asset allocation. Once again, there's two final building blocks that we're looking to make recommendations on. One of them today is infrastructure. The other one would be real estate. So with real estate, following the infrastructure discussion, it would be good just to get your guys' thoughts on who we could bring in at your convenience, just to wrap up the discussions, with the acknowledgement that they have to sign off on certain stipulations around contracting and so on. But you can see here that the infrastructure allocation is 7%. So we have definitely got room in the portfolio for 2 managers of the 3 that were interviewed. And then on the real estate side, we're looking at a 3% allocation. We could still look at 2 managers for that allocation as well. So just wanted to mention that as we think about bringing finalists in. Okay. So that is the overview of the portfolio, the markets. Nothing to really report that's troubling as we've continued to hold up and navigate pretty well.
Yeah. Two quick questions just for general knowledge. So as we have the equity run up, we're really impressive right now. We're benefiting from this volatility in a good way, right? Mm-hmm. Do we have any triggers that cut off, you know, our run up, right? Yep. Can you speak to that?
Yeah, absolutely. So within our policy, we have a ability to go plus minus 5% on the weightings. Mm-hmm. So as we creep over 5% on certain asset classes, that's where we would naturally trim back.
Got it.
Yes.
That answers the second part of the question. So it's not a calendar. It's definitely a trigger at the percentage. Correct. You don't have to wait quarterly, monthly, or anything else. Once you hit the trigger, hit the 5+, you can go ahead and begin to sell off, or?
So we would need your approval, so we don't have discretion to do
Okay,
that.
that's what I was.
But here's an example. On the non-US equity front,
Yeah.
we're at 4.5%. While we're comfortable with the 4.5% and we're like, let that run, we could, for example, in light of the fact that we're not going to meet for a couple more weeks, polling all of you, if you're like, let's trim back a little bit, we can do that now versus the next time we meet. Because unfortunately, we wouldn't be able to, without sitting here and getting your guys' approval, we wouldn't be able to do anything. So that would be one area of the portfolio. If you all wanted to, we could trim it back to about half the weight and just place that in cash. I think cash versus fixed income, while the Fed figures out what it's going to do.
You just generated another question. Yeah, because I'm oversensitive about our fixed income, and I think we talked last time about comparing how the infrastructure and real estate kind of buoy things. But with the new Fed, there's a lot of unknown. I think some unfamiliar territory is in front of us.
Right.
And so every level of protection for this group is important, because as Trustee Joseph will remind us, even though he's not here, he's always going to say, we can't just raise more funds.
Right.
So it's much easier to replace money in the equities market than fixed income if that value is lost.
Correct.
So I'll be very interested in how we approach that.
Yeah, absolutely. So I think what we can do here, if it's at the pleasure of the committee, we could bring down the target, halve it now, with the understanding that we're being just proactive around markets, volatility. 4.5, we can round that up to 5%, essentially. So we could.
Excuse me, the market has been very resilient, even though this war and all of this negotiation with Iran.
Right.
As far as April was an outstanding month.
Yes,
Yes.
absolutely. Yeah, April was an outstanding month. Now, with the markets, the one thing we have definitely seen is just more volatility. So it's more of a roller coaster ride, right? So even though it's strong, on certain days it can really just go down. Other days it can go up. So one of the thoughts here would be, to continue to benefit from the strong run in the market, but perhaps take some chips off the table. So as opposed to just rebalancing everything, take it down to a 2.25% overweight.
You're saying lower down your expectation.
A little bit, particularly with the summer. If we look at summertime statistically, summertimes are usually when something crazy happens.
Especially with the new chairman coming in, nobody knows.
Right.
I mean, if he's going to be a puppet to the White House or he's going to be a independent, just like Mr. Powell was.
Right, exactly. So all of this are the unknowns, and unknowns will at least guarantee
So
volatility.
we can definitely shield ourselves from that volatility if we put in the right class.
We would say that the next discussion we'll have around infrastructure is absolutely one of the areas of the market that we feel is a lot more immune to the noise that's taking place.
This infrastructure is U.S. infrastructure or global?
It's global. So the managers that we have, we've got.
Because most of those presentations, I didn't see anything outside of U.S.
No, they all had outside of the
It was
US.
all outside.
No, some, like they were talking about the data centers and stuff.
The data center component was in the U.S., but the portfolios.
No, I know that it was diversified, but that was
Yeah,
a
so-
major chunk of it.
So they're all global. So all the managers, IFM, Macquarie, Brookfield, they're all global. I would say Brookfield will have a little less global exposure versus an IFM and Macquarie, but they all did have some international exposure, which is also a good thing when you think about just the asset class, the maturity, the diversification. But all in all, let me, in terms of order of operations, let me pause for a moment, because I know we're here on the rebalancing.
Yeah.
Just wanted to get your direction with respect to next steps on the rebalancing, and then I can convey that to my team if the goal is to just bring down some of the overweight presently.
Yeah, I'm in favor of that. I think that when we have a market run-up, the guarantee is that at some point it's gonna come down, especially in this environment with, like I said, uncertainty gives volatility. I think, we have a good corridor of 5%. I think just for caution, maybe bringing that down for a while to 2.5 makes sense, because cash is really doing well for us versus the uncertainty of fixed income. And so cash management, I like it. Interest rates are up. We're making money off of that, right? Yeah,
Yeah,
great.
Chairman, just to add for, I guess, Marquette's information, well, we do have to fund those last two managers, in Channing, I believe.
Yep.
So that cash flow has to be factored into any drawdown that potentially exists. So if we could look at what's that funding gonna be required in the next, I guess, couple weeks, because now they've signed all the agreements.
Yeah, great. That's a
and-
great update.
And
Thanks.
then we're looking at what potentially might be overweight in the 4 to 5%.
We should be okay. Thank you for bringing that up, Grace. So as we think about the fundings taking place here, we'll actually see that they're going to come from the index funds. So the index funds will give us that liquidity we need as we think about some of the new managers coming on board.
Right. They're not coming from cash.
Correct.
Right.
So the one area, however, we could see cash coming out would be on the private markets.
Right.
So the private markets, as they call capital.
I was gonna say that steps in though, right?
Yes, they usually give us enough notice, but that's, again, something we want to be sensitive about as we think about, just cash and how much cash we're holding. So that's a fair point there.
So from your perspective, you said that y'all were comfortable with 4.5 overrun given the volatility. At what point would you say we would, from your perspective, we should look at? Because I know you said 2.5 is where more you're looking at. What would be y'all's trigger to say, hey, we should look at rebalancing?
So it would be 5%, and then the next question prompted, would we be able to rebalance immediately if it hit 5%? And the answer would be, unless it hits 5% while we're here at the board meeting, it would be a no. So that's where a little flexibility around the 4.5. I was like, well, 4.5 is close enough for us to at least start taking some things off the table now, because it may be.
Rebalance, what does that exactly look like? Does that rebalancing go towards the funding mechanism that Gray was describing, or does it go towards some underweight areas? I mean, where does that?
Yeah, so it would go towards the cash portion of the portfolio. So right now, in this environment, we're seeing more volatility from our traditional fixed income, just given the uncertainty around interest rates. So we would use cash as a proxy for fixed income. So fixed income is underweight 1.1%. So technically, if you use cash as a fixed income proxy, the cash would be shoring up our fixed income underweight. So we would take the money down from emerging markets by 0.5% of where it is. So from 4.5 to 2.25, and then put that 2.25 into cash. And we could look at that cash as, instead of being down 1.1% in fixed income, we would actually be slightly overweight in fixed income, because cash is operating like fixed income now without the volatility of fixed income.
So we're 13 million over. It represents that 4.5%. So you're talking about taking around 6 million
Yes.
into cash.
Yes.
I think, just for the chairman, you would have to calculate the numbers if you round to say that's 5%. What are the actual sort of overages? How long has it been over or at 5% from a duration standpoint? To get the committee informed about, some real numbers.
Yeah,
Would that be a next step?
yeah.
Yeah. following the investment policy statement, just trying to
Yep.
stick to that.
Yep. Sounds good.
Yep.
Did you say that all contracts that were pending have been signed?
There's one signature, I think, out, but they've finally agreed on all the terminology, so that's in one of the slides, yes.
Finally. Okay. Did that make sense about the cash position?
Yeah, so the next step, it sounds like, is they're gonna get us some numbers on how long it's been at
Mhm.
that level, and then what potential numbers it would look like if we were to rebalance and put it into cash.
Yep.
And so that would be next month?
Mm-hmm.
Okay.
Oh, wait, we're in May. Yeah, okay.
So do we need a motion to make, to,
No, we would do it, next meeting.
okay.
We wouldn't be able to do it this meeting.
Okay, so that would conclude the performance overview. And we will circle back on the overweight amount and then the rebalancing amount. We'll pass that through Gray procedurally.
Mm-hmm.
So this takes us now to infrastructure. Infrastructure, 7% of the asset allocation. We do have a proxy allocation through Cohen and Steers, so that would be the funding mechanism as we think about hiring any managers, potential managers from this list. So again, we don't have to worry too much about where the cash is going to come from because we have that placeholder through Cohen and Steers. So you all met with 3 managers, Brookfield, IFM, Macquarie. These are 3 infrastructure managers that operate in the core infrastructure space. We think about these strategies, they are really focused on investing in what are known as brownfield assets. Brownfield, these are your slightly more mature, cash-yielding, monopolistic assets, for lack of a better term. So the cash yield is going to be a healthy component of the return, and then appreciation would also be a source of return, but perhaps not as big a source of return. That may change a little bit over the coming years, just with the whole data center discussion that's taking place. Data centers are probably a source of appreciation, but these wouldn't represent the bulk of any type of portfolio, with that being said and done. So as we think about infrastructure, why is it in a portfolio? It's a diversifier, and it's also really a hedge on inflation. So you'll see that the metric that's used below is CPI plus 5%. That used to be a low benchmark, right? CPI plus anything, but CPI plus 5 in today's age is a pretty healthy bogey to look at. And you can see that infrastructure keeps up very well. There is a positive correlation with inflation, which is, again, a good thing. Asset classes like fixed income will typically sell off at the sign of any type of inflation. Equities will see volatility at the sign of inflation, and then you'll see some winners and losers based off that. And then infrastructure, you typically see that positive correlation because they have lock-in or guarantees or catch-ups that are in lockstep with inflation, basically. So as we think about the asset class, it's really an all-weather asset class. Whether it's a down environment economically or an up environment economically, you expect infrastructure to hold up pretty well when all is said and done. Because again, these are essential goods and services that are paid for irrespective of the economic environment. As we think about the performance, you will see that the performance of a Brookfield is steady. You'll see that the performance of a IFM is also a steady, but perhaps a little bit higher than what you'd expect from a Brookfield. And then Macquarie, I think the key answer here is it's a newer fund. Newer fund will have newer assets. Newer assets will benefit if they've been underwritten well from pretty tremendous markups, if they've been underwritten well. So the shorter return stream, the newer portfolio You can see here that Macquarie's come in with a slightly higher return, but as the portfolio matures, you'd expect it to morph into something more like an IFM as you think about a more diversified pool of assets, essentially. As we think about these infrastructure managers very quickly, I think the legal component of things was also a key consideration. And just given feedback from the legal folks, it does appear that both Brookfield and IFM were institutions that they didn't run into any hurdles with as we think about the paperwork and signing off on mandatory stipulations. I think Macquarie was the area or the one manager where there was a little grayness on can they actually sign the paperwork and would there be a headwind with them if we move forward with them. So I think it makes the decision that much easier in that respect, where IFM and Brookfield both really good complements with each other. We have several clients that use both managers in this combination. They are good complements to each other. So based off all of that, the recommendation from Marquette's end would be for a 50-50 split between IFM and Brookfield. Macquarie is a solid manager, but again, we have to be mindful of actually getting the funds up and running in the portfolio. So that also leans us strongly to your IFM and Brookfield. But I'll stop and see if there are any questions.
I wanted to reiterate why would we even consider somebody bringing them on board if they're not comfortable with our rules and regulations? Because the previous fiasco
Right.
took almost 2 years to finalize the contract. So
Right.
let's not even consider somebody who cannot come on board
Absolutely.
freehand.
Absolutely. Absolutely.
If you recall, there was a fourth manager, and that's what eliminated them.
JP Morgan.
Yeah, JP Morgan, that eliminated them. Macquarie isn't saying they won't do it, it's just not as easy, as streamlined
Correct.
as the other two. I also recommend Brookfield and IFM, but for different reasons, for performance. I don't want us to be excited or attracted to Macquarie's return. I love the firm, but they're not giving us access to one of their hallmark funds. This is a newer fund, and they're using their track record and reputation for some previous history, which is excellent, right? They're a great fund manager.
Yep.
But this is a newer fund, and this is not the bucket of money where we're chasing return. This is the bucket of money where we want to level things out. And so Brookfield, they do that the best, but they are, to your question earlier about international, they started out because they were operators. They are really highly concentrated US. You know what you're going to get, which is excellent for this. But I also think that, for the last 20 years, if you don't have international, you're not really stabilized. And so there comes IFM with a more robust global, opportunity. And since we do have enough allocation, that's why my recommendation would be to split between those two.
Yes, I'm on board.
Brooksfield looks like 51% is US based
Mm-hmm.
of their fund.
Yeah.
But these are IFM and Brookfield, both solid managers. We consider them best in class, both staples as you think about go-to core infrastructure managers. And again, demonstrated over and over, just consistency of returns, discipline of underwriting, the ability to source good investments in the portfolio. So very, very comfortable from this end, recommending these two quality managers, particularly as this is viewed as more of a ballast in the portfolio for us.
So this would be 10 million each, 3.5% allocation per.
Yes.
Any other questions around that evaluation, those presentations?
No, sir.
Great. Any other information you want to share with us about that quickly?
Not on infrastructure.
Okay.
Quick question, to confirm the 20 million matches up to the allocation based on the slide up here? So I did have a question about, the 3% is the 20 million? Can we confirm that number on your?
I had 7% allocation was 20 million.
So 3% is real estate, and then 7% infrastructure.
Okay.
In total, it's 7% for infrastructure.
And the 7% comes out to 20 million?
Give or take, yes.
Okay. Thanks.
And that doesn't hit up against either of their minimums?
No, their minimums are, I think, $1 million.
Yeah.
Oh, okay.
Yeah, so we're definitely good. We've entered large investor territory, which is a good thing when we think about the size of our pool, which is kind of good.
It's definitely interesting
Mhm.
between Brookfield and IFM.
And there'll be periods where you might see Brookfield do a little better, where again, the data center story in the US, if that takes off significantly more, that's where you could see a Brookfield do a little better than, let's say, an IFM. And then on the flip side, trying to think of that's just one example, but they're very good complements to each other when all is said and done. One is a much more mature portfolio in the case of IFM, and then Brookfield, even though it has a longer track record relative to Macquarie, they're still kind of building, they're still acquiring more relative to, let's say, an IFM from a portfolio construction standpoint.
So just for everyone, just because I wrote these comparisons, Brookfield had a 15.5 billion value, 10% average returns, represents 29 businesses and 300 clients. IFM, 68 billion, 8 to 12% returns, represents 23 companies and 750 clients. So that's kind of the
Mhm.
Yep. So mega funds to just acquire those infrastructure assets outright. So there's different ways to access infrastructure, and the way we're doing it, it's through less debt, less leverage, and more through the funds that actually own these holdings, basically. So they'll own, in many instances, like 80% plus of the operations, and that's why they're so big in terms of their size and volume. The closed-end funds would be operating off leverage and financial gearing, basically, so they wouldn't own so much, but it would be a lot of debt, and the hope would be the investment thesis would pay off significantly, but that's not in line with our risk profile as we think about what infrastructure should be doing for us. So that explains the sheer size of these funds, which is a good thing. It should give us comfort that these are big funds as we think about these infrastructure assets being owned. And it will be very similar to the real estate discussion we're having, where real estate, there are many ways to access real estate. You can access real estate through closed-end funds, which again, there'll be some degree of leverage, equity ownership, and then there's the open-end funds where these funds own the majority of the properties and there's less debt on the books for owning these properties. So given our risk profile, we're also looking at open-end real estate, which you'll see some pretty lofty numbers when we think about the size of these funds and the types of properties that they own. So that would be it for infrastructure. I've made the recommendation, and I'll just pause and just make sure that the order of operations is being followed on your guys' end. I don't know what would be next at this point.
Do we need
Or-
a motion?
Or infrastructure.
Yeah. So we go to Gray, right?
Yes, thank you, Chairman. For the committee, there's included a resolution for the recommendation to select a global private infrastructure manager. There's a target allocation of 7% in our investment policy statement. Our investment consultant, Marquette, has initiated an open search process, brought in 12 responses. They've been narrowed down, and the resolution indicate this selection of 3.5% and 3.5% to IFM and Brookfield. So to recommend that those investment be moved forward to the Board of Trustees. So appreciate the committee's consideration of Resolution 66-2026.
Thank you, Gray. May I have a motion to approve Resolution R066-2026?
Aye.
Been moved by Trustee Makbul,
So, second.
Second by Director Pacho. Any discussion? None? Any public comment?
No public comment, Chair.
All in favor? Aye. All right. Any abstentions? Any nays? All right, motion carries. We've selected our managers for the private infrastructure class. Thank you very much.
Chairman, I just wanted to ask you, when would be the effective date on this?
Effective date as
Like when
in,
they actually come on board with this?
Yeah, after the Board of Trustees votes,
Yeah.
the legal paperwork is signed.
Okay.
right.
So
So we,
you anticipate within another 30 days or so, you would have them on board?
Could be a little
I'm
longer
about to say,
than that.
that's an ambitious timeline, but I think after we get it, once they get notified that the full board approved it, then we can talk timeline. I think that
Okay,
would,
it's
right.
usually a quarter, under a normal timeline, maybe a quarter that seeps into a quarter and a half.
By September, you think?
I think that's really reasonable, yeah,
it's good.
yes.
Okay, good deal. Any other comments, questions? None? Any public comment?
No public comment, Chair.
Thank you very much. No other matters, I'll take a motion to adjourn. Oh, yes, I'm sorry.
There's one more agenda item, just
Oh, really?
for your direction,
Oh.
which is on the real estate side of things. So this would just be to get your permission to coordinate and get time on the calendar, subject to everyone's availability, just to meet with these real estate managers, which will be the final piece of the
Right,
puzzle.
right. So we don't have, do we,
Is that on the agenda item?
yeah,
It is, so it's not a recommendation, it is just to get, so we're not recommending any managers or anything. We've gone through the searches, we've discussed real estate previously, and we got down to the list of 3 managers here. So really, this was just an informational item to see if we could move forward with sending contract language to these managers to see if they can sign off, and then based off that, having them come in to present. So
But it's not identified as an action item on the agenda.
no. I don't think we need, we just need Marquette and Associates to reach out to them to continue
yes,
your process.
correct,
of making sure everyone is eligible before we entertain bringing them in.
correct.
So we don't, that's not an action for us in my understanding, right?
Yeah, it was just to keep you all in the loop that.
Yeah, you're just
so-
letting us know,
It's
yeah,
not an action item.
you're just letting us know
Yes.
that
Okay.
that's your next step.
Yes.
That's great, that's
Okay.
great,
Yes.
okay, all right, good deal. And if we didn't mention, we had some action, information items rather, and I was ready to entertain a motion to adjourn.
Aye.
Moved by trustee McBool,
Seconded.
second by trustee Johnson. We are adjourned. Thank you very much. All in favor? Aye. Sorry, we are adjourned. Thank you.
Thank you, sir.
Thank you.